The following analysis represents a reasoned perspective grounded in the investment philosophy I've upheld for over 6 decades. While I am not in the business of forecasting commodity prices or reacting to headlines, I do believe it's worth examining major financial developments through the lens of long-term value, sound economics, and rational decision-making. In this case, we're looking at the rising attention surrounding gold and silver, driven not by war or sensationalism, but by deeper forces within the U.S. fiscal system, namely unsustainable debt levels, the weakening purchasing power of the dollar, and the behavioral shifts of investors worldwide. What you'll read here is a reflection of how I might interpret these events. Were I writing a letter to the shareholders of Berkshire Hathaway or speaking from the stage in Omaha? This is not investment advice nor a call to action. It is a sober-minded examination of risk, insurance, monetary value, and the changing landscape of trust in fiat currencies. The goal of this reflection is not to chase predictions, but to understand implications. It's built on data, not drama, and it approaches gold and silver not as speculative instruments, but as assets that may offer protection in an environment where long-term fundamentals are being challenged. Let's walk through the key issues together, with the clarity, caution, and conviction that long-term investing demands. If you've been watching the price of gold and silver lately, you might be tempted to think the headlines are driving the value. War in the Middle East, political turbulence in the U.S., even rumors of drastic rate cuts. These are the kinds of events that make markets twitch. But as someone who spent decades studying how capital flows, I'd caution against building your thesis on noise. Instead, I'd suggest looking at what really determines long-term value: fundamentals, behavior, and incentives. Let's get straight to the point. The United States national debt has officially surpassed $37 trillion. That number matters, not because it's shocking or controversial, but because it represents a structural challenge that affects the entire financial system. At Berkshire, we don't make short-term bets, but we do observe long-term signals. And when a nation's debt begins to eclipse its productive capacity, history teaches us that something has to give. Now, a lot of people are asking, will this drive the price of gold or silver through the roof? Maybe, but not for the reasons most assume. Gold and silver, in their essence, aren't speculative assets. They're not productive businesses, nor do they throw off cash flows. But they are monetary anchors, especially in times when people begin to question the reliability of fiat currency. I've said many times that gold doesn't pay dividends. But I've also said that when confidence in paper money fades, tangible assets become more appealing. We are beginning to see signs of that shift. One of the most telling examples? The growing discrepancy between physical and paper silver markets. In China, the Shanghai Gold Exchange recently listed physical silver at $37.50 an ounce. Meanwhile, in the U.S. futures market, silver hovered around $36. That gap may not sound massive, but it speaks volumes. When the price of a physical asset detaches from its paper representation, it usually means one of two things. Either arbitrage is about to correct it, or confidence in the synthetic version is eroding. It gets even more interesting when you consider the volume of silver traded. On June 20th, the paper silver market moved 610 million ounces. That's 34% of global annual production in just one day. If you think that's normal behavior in a healthy market, I'd encourage you to think again. That's not investing. That's speculation in its purest form. I've always said, when you're playing poker and you don't know who the patsy is, you're the patsy. And in markets with this kind of leverage and opacity, many retail participants become the patsies without even realizing it. But let's return to the bigger picture. The debt. When a country borrows at today's scale and prints money to cover the difference, it distorts price discovery, not just in precious metals, but across the entire capital structure. The Federal Reserve has kept interest rates historically low, which in turn has inflated asset prices across the board. Stocks, real estate, corporate bonds, even artwork. Many are priced far above their intrinsic value. And while I don't invest in gold or silver directly, I understand why some people are beginning to see them not just as stores of value, but as protection against monetary dilution. Here's something I've said before. If you don't find a way to make money while you sleep, you'll work until you die. The irony is, many people think they're investing by buying whatever the headlines hype. But in reality, they're just speculating. True investing is buying something because it's worth more than what you're paying for it, and holding it until that value is recognized. So the question becomes, is silver undervalued? Well, let's talk about the paper-to-physical ratio, which currently sits at 364 to 1. That means there are 364 claims on each real ounce of silver. Imagine if every person who held a claim wanted to redeem it. That's not a market. That's a time bomb. In business terms, that's like a company issuing 364 IOUs for every product on the shelf. If that happened at See's Candies or Geico, we'd call it a crisis. But in financial markets, it somehow passes for normal. This is why I focus on tangible value. Paper promises are fine until they're not. And when trust evaporates, people turn to what's real. That includes businesses with durable moats. But in times of monetary strain, it also includes metals that have served as currency for thousands of years. Now, I'm not telling you to sell everything and buy silver bars. I'm saying, understand why certain things are gaining attention. Gold and silver aren't rising because of panic. They're rising because people are gradually realizing that you can't print prosperity. And that brings us to another driver, behavioral momentum. As more investors seek safety from currency risk, they begin to flock to what feels stable. Silver, often seen as a poor man's gold, becomes attractive not just because of its affordability, but because of its relative undervaluation. Look back through history. Whenever nations lost control of their money supply, whether Weimar Germany, Argentina, or Zimbabwe, those holding hard assets weathered the storm better. The U.S. is not Zimbabwe, but the mechanisms of monetary erosion are universal. They don't explode overnight. They decay quietly until one day they're too large to ignore. If you've stuck with me through this breakdown, I appreciate your attention, and I'd love to hear your perspective. What do you think happens when trust in fiat begins to waver? Drop your thoughts below. The conversation matters more than ever now. Markets aren't always rational in the short term, but over time, they tend to reward value and punish illusions. That's one of the oldest lessons in investing. And when I look at what's happening in the silver market today, I see signals, some loud, some subtle, that suggest value is being ignored by many and quietly accumulated by the few. Let's begin with ETF flows. While I don't personally invest in commodity ETFs, their behavior tells you a great deal about market psychology. Over the past several months, we've seen a steady increase in the amount of money flowing into physical-backed silver ETFs. Whether or not those vehicles truly represent one-to-one ownership of silver is another debate. But the fact remains, investors are voting with their dollars, and they're beginning to hedge against uncertainty. Silver has always been the more accessible cousin of gold. In environments of growing concern, where people begin doubting whether their dollars will hold value, silver often becomes the entry point. And here's something I think most people miss. Demand for silver isn't just about investment. It's also about utility, design, and culture. Take silver jewelry, for instance. The Silver Institute reports over 200 million ounces of annual demand for silver in the jewelry industry alone. And that's during a period where consumer focus has largely been on status-oriented spending or digital assets. Now, imagine what happens when the fashion pendulum swings back to tangibility, when minimalism, craftsmanship, and real-world value return to the forefront. Silver, with its aesthetic beauty and affordability, becomes more than a store of value. It becomes a statement of taste and prudence. This growing demand is not theoretical. It's already happening at the microeconomic level. I've seen countless businesses throughout my life where a simple shift in consumer psychology created outsized market results. When enough people decide they want real over speculative, practical over hyped, the market doesn't shift gradually. It often moves all at once. Now combine that jewelry demand with what we call latent investment demand. At the retail level, average investors, those not yet thinking about inflation hedges, have been relatively quiet. But markets don't stay asleep forever. When inflation creeps back into headlines, or when another financial shock strikes, that dormant demand can come roaring back. And if even a modest portion of the population decides to allocate a small percentage of their assets to physical silver, the current supply won't be able to handle it without significant price appreciation. Here's where fundamentals intersect with human behavior. People don't react to debt figures immediately. They don't respond to fiscal policy in real time. But over time, when the grocery bill doubles and home prices outpace wages, they begin to search for answers. And when traditional narratives about stability break down, they start asking better questions. What holds its value? What can be printed? What can I touch, store, and pass on to my children? That's when metals like silver become emotionally compelling. An emotional compulsion, when matched with real supply constraints, moves markets. Bank of America recently reaffirmed their price target of $40 per ounce for silver by Q4 of 2025. I don't rely on price forecasts, because in my experience, trying to predict specific prices at specific dates is a fool's game. But I do pay attention to the direction and reasoning. And in this case, the logic tracks. They cite an expected normalization of trade tensions, acceleration of global growth, and a rebalancing of the gold-to-silver ratio, which still hovers around 90 to 1. Historically, that ratio has been closer to 40 to 1. So even without new catalysts, there's room for silver to appreciate just by reversion to the mean. It's important to pause here and reflect. Silver is not rising due to hype. In fact, most of the mainstream media still downplays it. That's a clue. The best opportunities are often the least glamorous. That's how it was with Coca-Cola in 1988. That's how it was with Apple in 2000. And today, while silver doesn't have a corporate logo or earnings call, it has something else: scarcity, relevance, and trust across civilizations. So what's missing? Retail conviction. The average investor still believes in the permanence of fiat systems, still trusts that central banks will figure it out, still assumes that every dip in the market is a buying opportunity for tech stocks. And perhaps they're right, for now. But smart capital allocators don't wait until everyone agrees. They prepare when prices are still reasonable and the herd is still distracted. I'm not telling you to become a silver evangelist. I'm telling you to think like an owner. If you believe silver is an undervalued monetary asset with growing industrial, cultural, and investor demand, then you must ask yourself, what am I waiting for? The best time to plant a tree was 20 years ago. The second best time is today. Before we move on to the next section, where we'll discuss the fiscal recklessness that's driving these asset flows, the political pressure mounting on the Federal Reserve, and how history teaches us what happens next, I want to hear from you. What's your long-term thesis for silver and gold? Do you view them as hedges, core holdings, or just insurance? Let me know in the comments. As always, insight from thoughtful investors is what makes this community valuable. We've talked about silver and gold. We've looked at the mounting demand, the structural shortages, and the behavioral cues suggesting something is shifting beneath the surface. But now it's time to face the harder truth, the one most investors are reluctant to confront. The United States is in a fiscal situation it cannot print its way out of. As I write this, our national debt has eclipsed $37 trillion. It's easy to tune that out, the way one tunes out background noise at a busy airport. But let's be clear, this is not a trivial figure. It represents not just borrowing, but borrowing that's compounding at a rate far beyond the country's ability to repay through organic economic growth. In the short term, the government has options. It can sell more bonds. It can negotiate spending cuts. It can raise taxes. But all of these have limits. And when those limits are reached, the Federal Reserve becomes a backstop, willing or not. This is where we enter the realm of what economists politely call monetizing the debt. That is a sanitized way of saying the Fed will print money to buy bonds the market no longer wants. It's not the first time this has happened, and it won't be the last. But the consequences are clear. Every time the Fed expands the money supply to absorb debt, it devalues the purchasing power of every existing dollar. You've seen it at the grocery store. I've seen it at Berkshire's operating companies. Raw materials cost more. Labor costs more. Logistics cost more. And when the underlying currency loses value, all pricing mechanisms shift upward. Slowly at first, then suddenly. Now, add in the political pressure. Donald Trump, whether you support him or not, has called for a 2.5% rate cut, effectively demanding the Fed juice the economy at any cost. He's even gone so far as to attack Fed Chair Jerome Powell personally, calling him one of the dumbest and most destructive people in government. It's not my job to comment on politics, but it is my job to think about incentives. And when the head of the government demands lower rates while the central bank is still fighting inflation, you begin to see how fragile the illusion of independence really is. Markets like certainty. They like rational expectations. But what we're seeing today is a departure from that. We're entering an era where the rules that govern monetary stability are being tested, if not outright ignored. And this is where gold and silver come in, not as speculation, but as anchors in a storm. As someone who built his fortune by buying businesses, not metals, I don't say this lightly. I've always preferred cash-flowing enterprises with pricing power, loyal customers, and predictable costs. But I also understand that there are moments in history when preservation of capital becomes more important than growth. Gold and silver have no earnings reports, no quarterly guidance, but they also don't default. They don't dilute, and they don't require bailouts. They just are. And for thousands of years, people have turned to them not because they're exciting, but because they're enduring. And that's the key word here, endurance. Let's return to Bank of America's forecast. A potential rise in gold to $4,000 an ounce and silver to $40 or beyond isn't predicated on war or fear. It's based on math. When deficits balloon, when yields can't rise without breaking the system, and when global trust in fiat weakens, hard assets rise. Not because they become more valuable, but because the currency measuring them becomes weaker. If you're an investor thinking long-term, here's what I'd advise. Think in real terms. Don't just look at nominal returns. Ask yourself, is your purchasing power growing? Understand liquidity. Precious metals are not easily confiscated, and they don't rely on third-party platforms. That has value. Prepare for volatility. If the system adjusts, the transition won't be smooth. But those who are patient, rational, and disciplined tend to fare best. At the end of the day, value will prevail. It always does. But the journey from distortion back to fundamentals can be bumpy. That's why the time to think clearly is before the crowd panics. So here's my final thought. Don't do what's popular. Do what makes sense. Ignore the shouting. Look at the balance sheets. Study incentives. And remember that history rarely repeats. But it does rhyme. If you found this perspective helpful, share with someone who's still focused on the headlines and missing the bigger picture. Not because we're trying to sell anything, but because clarity is contagious, and it might help them avoid decisions driven by fear rather than logic.